is an overlay of the 10-year Treasury and the Fed funds rate. And why I thought this was important, just because the market situation we're in right now, a little bit of history and context always helps. So going back here, you see from this is about as far back as it goes, but this was probably, the end of, like, the Great Recession when it started. So in the end of the 20s, 1930, that's when they started lowering this Fed funds rate to kind of spark the economy from the recession. And this was where the 10-year Treasury was. So look how long we sat down here. This was a long run at zero, re-sparking everything, which then caused, as we came off the gold standard and everything else, the Fed started to raise rates to fight inflation. The 10-year just went sky high until it peaked over here in 1980 at almost 14%. 14% interest rates. So apparently throughout this time, they must have been trying to correct the situation, but it was one of those situations that they couldn't. So we settled down from that. It took how many years? It was 40 years to get back to where we are. And we had COVID right over here. But this lower Fed funds rate started pre-COVID. Then on its way up, COVID happened and we ended up back down again. So we have theoretically almost a similar amount of time where we were at this really low, actually it was even lower than that, zero rates for a long time. When it does turn, it looks like it's more of this upward slant than a, hey, just correction, we're back down to normal, which with the video I shared yesterday about the longer term of the 10-year Treasury and the longer term cycle of rates, there's a window where this might not be the end, this might be the beginning, because every cycle has a boom and a bust. And if you look at it like a stock, right, it had a long stretch down here, then a long on run up, and then a long reset. And now we've been basing out, and this would theoretically be when we would start to climb again. So options for refis, take them when you got them. I'm telling you right now, this will be something that if we spike up, besides the damage that could be if we do run into a stagflation situation where rates are 10, 12%, but you can't, there's unemployment, so you really don't have the work to sell. That's where you run into these sorts of situations. And to have an interest rate that you can get yourself down into the fives is dicey anymore. It was good. About a week ago, I had some fives in front. But you're going to get stuck in a situation where you're going to have made that move down, because even if it just doesn't come, this is not going to come right back down. It's done this in the past. It's up and right back down, up and right back down. I think we're past that right back down part. And you can say even from last year, we went up. It's not going to have all the current data because I had to go and kind of back find the data. This data didn't exist back then, so I had to kind of compile it. But this would be, the situation where we don't see those lows again. We're definitely not going to see this zero mark, but we could slowly creep higher too. So something to share as I do the market update today with Bitcoin and some other things. But you got to look at history to know where you're going, and just turn off the news. Turn off what your friend says and what you heard and the builder that knows this and this guy that knows that. Nobody knows anything, even me. All you do is look at the data and try to put things together in a probability sense of, this lining up with this lines up with this. And that's where you start making educated guesses. That's about the most you can do. But consuming information just from online with many sources there are is going to make you miss something like this, right? Just looking at this chart should make you think.